If you observe carefully, something extraordinary is happening right under our noses. Millions of Americans wake up every day, go to work, pay their bills, and think they're doing everything right financially. They look at their bank statements and think, I have the same amount of money I had last month, but here's the truth that few understand. You're losing money every day, even when your numbers stay the same. How is this possible? The answer lies in one of the most powerful and misunderstood forces in the modern economy: Federal Reserve policies. This isn't a conspiracy theory. This isn't an alarmist prediction. It's a mathematical and historical consequence of how monetary systems work when they follow certain patterns. If you understand the incentives behind Fed decisions, you understand why your purchasing power is being silently eroded, and more importantly, you understand what you can do to protect yourself. History is an excellent teacher, and it shows us we're living through a moment that has happened before multiple times over the past 500 years. The difference is that now you can recognize the patterns before it's too late. Let me tell you a story you've already lived, even if you don't know it. In 1913, when the Federal Reserve was created, a dollar had virtually the same purchasing power it had maintained for over a century. Gold was at $20 per ounce, and that rate had remained relatively stable since America's founding. If you had saved $100 under your mattress in 1913, you'd have the equivalent of about $3 in real purchasing power today. This wasn't an accident. It was the predictable result of a system that works exactly as it was designed to work. Monetary history teaches us that every time governments and central banks gain the power to create unlimited money, the same pattern repeats. First, they use this power moderately. Second, they face crises that force them to print more. Third, printing becomes a regular political tool. Fourth, the currency loses value gradually, then rapidly. This isn't an American pattern. It's a human pattern. The Romans did this when they mixed base metals with their gold and silver coins. The Chinese did this during the Ming Dynasty when they printed paper money in excess. The Weimar Republic did this in Germany in the 1922. Zimbabwe did this in the 2000s. Each of these cases followed the same logic. When you can solve problems by creating money from nothing, you eventually create problems that can only be solved by creating more money from nothing. Now, let's be clear. The United States is not Zimbabwe. The dollar is the world's reserve currency. This gives us extraordinary privileges and more time to correct imbalances. But the fundamental principles of monetary mathematics don't change just because we're Americans. If you increase the supply of something faster than its demand, the unit value decreases. This is true for potatoes, it's true for used cars, and it's true for dollars. Since 2008, the Federal Reserve has expanded its monetary base by more than 400%. This isn't a secret. They publish these numbers monthly. What many people don't understand is what this means for their money kept in checking accounts, savings, and fixed income investments. Let's break this down into parts anyone can understand. When the Federal Reserve decides to print money, technically create bank reserves digitally, they're not literally operating printing presses. They're creating money from nothing through computer entries. The Fed buys government bonds or other securities from banks and dealers. In exchange, they credit these banks' accounts with new money. This money didn't exist a second before the transaction. It's as if I could write checks without having money in the account, and the bank was forced to honor those checks by creating the money at the moment of transaction. This new money enters the financial system first. It goes to banks, which lend to companies and investors who buy assets like stocks, real estate, and commodities. That's why you see the prices of these assets rise before you see inflation at the grocery stores. New money doesn't reach all places at the same time. Richard Cantillon, an 18th century Irish economist, observed something fundamental. When new money enters an economy, it first benefits those who receive that money and hurts those who receive it last. If you understand this sequence, you understand why wealth inequality has increased dramatically since the Fed began its quantitative easing policies in 2008. Those who receive the new money first can buy assets before prices rise. Those who receive it last pay inflated prices without having received the benefit of the initial monetary creation. Who receives it first? Banks, fund managers, owners of financial assets, large corporations that can take cheap loans. Who receives it last? Salaried workers, retirees on fixed income, small savers, people who depend on wages instead of capital returns. Here's where the silent theft happens. If real inflation is at 6% per year, but your savings earn 1%, you're losing 5% of your purchasing power annually. The Fed keeps interest rates artificially low through its policies. This forces you to take more risk to preserve your purchasing power. They call this the wealth effect, forcing you to buy stocks and real estate to try to keep up with currency devaluation. But not everyone can or wants to take these risks, and even those who do sometimes lose when bubbles burst. Governments have a complicated relationship with inflation. Officially, they're against it. In practice, it solves several political problems. If the government owes $31 trillion and the currency loses 3% of its value per year, the real debt decreases without any politician having to vote for spending cuts or tax increases. Inflation is an invisible tax that doesn't require congressional approval. That's why, historically, governments with high debts eventually devalue their currencies. It's not malice, it's political mathematics. Let me show you this with a simple story. Imagine two neighbors in 2010, Robert and Michael. Both had $100,000 saved. Robert, following traditional safe investment advice, put his money in a combination of bank savings, 0.5% annually, and Treasury CDs, 2% annually. Michael, more skeptical about Fed policies, put his money in a combination of stocks, real estate, gold, and Bitcoin, which was just emerging at the time. By 2025, Robert has about $120,000 nominal, but only $85,000 in real purchasing power, adjusted for inflation. Michael has about $280,000 nominal, or $200,000 in real purchasing power. Robert followed all the rules. He was responsible. He avoided risks, and he lost 15% of his real wealth. Michael understood that in an environment of massive monetary creation, the biggest risk was not taking risk. Imagine you're on a giant treadmill moving backward at 3 miles per hour. If you stand still, you'll be carried backward. To stay in the same place, you need to walk forward at 3 miles per hour. To move forward, you need to run faster than the treadmill. The Fed's monetary creation is that treadmill. Inflation is the speed of the treadmill. Your investments are your walking, running speed. If your investments yield less than the real rate of inflation, you're being carried backward, even though you think you're standing still. Imagine two identical islands. On the first island, there are 100 people and 100 gold coins. Each person has one coin. On the second island, there are 100 people and 200 gold coins. Each person has two coins. Which island is richer? Neither. They simply have different prices for the same goods. Now, imagine you live on the first island, but the king of the second island can magically transfer coins from the second island to the first. He gives these extra coins to his friends first. The king's friends on the first island become temporarily rich. They can buy more things before prices adjust to the new number of coins in circulation. But eventually, everyone on the first island discovers there are more coins in circulation. Prices rise, and those who didn't receive extra coins from the king become relatively poorer. This is essentially the operation of the modern monetary system. Now, let's translate this to your personal situation. Margaret retired in 2015 with $500,000 in savings. She was conservative, following traditional advice. She put everything in CDs and safe government bonds. In 2025, she still has approximately $500,000 nominal, but she discovered that her monthly grocery shopping costs 40% more, her gas costs 60% more, her health insurance costs double. Margaret didn't lose money in a market crash. She lost money by following safe advice in an era of experimental monetary policies. David earned $75,000 per year as a manager. Over the past 5 years, he's received annual raises of 2 to 3%. He thinks he's making progress, but the prices of the assets he needs to build wealth, homes, college education for his children, investments, have risen 8-12% annually. David is running on a treadmill that's accelerating faster than he can run. Each year, he gets relatively further from his long-term goals. Sarah just graduated from college with $40,000 in student debt. She got a job that pays $55,000. In nominal terms, she's earning more than her parents earned at the same age. But a house her parents bought for $150,000 in 1995 now costs $450,000. Sarah would need 3 times more purchasing power than her parents needed to achieve the same financial milestones. Tom has a small business with 15 employees. In recent years, he's observed something strange. His raw material costs increased 25%, his labor costs increased 15%, but his selling prices can only rise 8% because competition is intense. Tom is being squeezed between cost inflation and customer resistance to higher prices. His profit margin is shrinking, even though his nominal revenue is growing. Small businesses can't finance themselves at rates close to zero like large corporations. They suffer from cost inflation without having access to the cheap money that feeds this inflation. The cruelest aspect of this situation is the compound effect. If you lose 3% of purchasing power per year for 10 years, you don't lose 30%. You lose about 26% due to compounding. If you lose 4% per year for 20 years, you lose more than 55% of your real purchasing power. This means someone who saved money safely for 2 decades may have lost more than half their real wealth, even if the numbers in their bank account have actually increased. If you understand the problem, you can build solutions based on solid principles. Don't put all your eggs in one basket, especially if that basket is denominated in a currency being intentionally devalued. Basic defensive allocation could include 2, 5, 35% in stocks of companies with pricing power, 1, 5, 25% in real estate or REITs, 10, 15% in commodities or mining, 5 to 10% in precious metals, 5 to 10% in foreign currencies or assets denominated in other currencies, and the rest in short duration fixed income. The biggest risk today isn't investment volatility, it's the deceptive stability of keeping everything in safe investments that guaranteed lose purchasing power. Real risk is the probability of not being able to maintain your standard of living in the future. Perceived risk is short-term fluctuations in the value of your investments. Most people optimize for perceived risk and ignore real risk. Some asset categories thrive when there's monetary devaluation. Companies with pricing power, well-located real estate, essential commodities, infrastructure, natural resources. These assets not only preserve purchasing power, but often increase in real value during inflationary periods. Traditional fixed income, bonds, CDs, loses purchasing power in inflationary environments. Focus on income sources that automatically adjust to inflation. Real estate rents, natural resource royalties, stocks that pay growing dividends, businesses with pricing power. You need some liquid money for emergencies and opportunities, but don't keep more than 6 to 12 months of expenses in cash. Money beyond that should work for you, not against you. The game has changed. Traditional investment rules were created for an environment where governments didn't create trillions of new dollars with every crisis. Understand how monetary cycles work, how to read Fed reports, how to identify asset bubbles, how to recognize changes in monetary policies. Extreme monetary policies eventually hit limits. When that happens, changes are rapid and dramatic. Maintain flexibility to adjust your strategy when the winds change. Let's suppose you currently have $200,000 invested, all in traditional safe investments. A gradual transition could be, in the first year, move 30% to a combination of stocks of companies with pricing power and REITs. In the second year, add 15% in commodities, precious metals. In the third year, incorporate 10% in international assets. This gives you time to learn, observe results, and adjust without making abrupt changes that can cause anxiety. If you observe carefully the history of civilizations, you'll perceive a pattern that repeats with almost mathematical regularity. Prosperous societies create sophisticated financial institutions. These institutions allow greater economic efficiency and growth, but they also create irresistible temptations for politicians and central bankers. The temptation is always the same: solve complex problems with simple monetary solutions. Creating money seems magical. It allows financing wars without raising taxes, stimulating economies without structural reforms, and postponing painful political consequences. This magic works temporarily, but the laws of mathematics and human nature are immutable. It's not possible to create real wealth simply by printing more monetary units. It's possible to redistribute wealth invisibly, transferring purchasing power from those who save to those who have first access to new money. Eventually, this transfer reaches limits. People begin to perceive the game. They lose confidence in the currency. And then dramatic changes happen quickly. We don't know exactly when this limit will be reached in the United States. It could be in 5 years. It could be in 15. The dollar as the world's reserve currency gives us more time than other countries have had historically, but we know this limit exists. And we know that people who understood these principles historically protected themselves better than people who trusted that this time is different. History doesn't repeat, but it rhymes. The instruments change, from adulterated gold coins to paper money to computer digits, but human incentives and political pressures remain constant. Your responsibility isn't to predict exactly when these changes will happen. It's to position yourself so you can prosper regardless of when they occur. If you understand we're in a specific phase of a long-term monetary cycle, you can make decisions based on principles instead of emotions. If you understand the Fed is following predictable political and economic incentives, you can anticipate the logical consequences of these policies. If you understand your currency is being intentionally devalued as an economic policy tool, you can protect yourself by investing in assets that benefit from this process. And if you understand these cycles eventually come to an end, you can maintain flexibility to adapt when changes arrive. Real wealth doesn't come from predicting the future perfectly. It comes from understanding timeless principles and positioning yourself to prosper in multiple possible scenarios. The money you're losing without realizing it can be recovered and multiplied if you apply these principles with consistency and discipline. This isn't a promise of guaranteed returns. It's a recognition that throughout history, people who understood these forces did better than people who ignored them. The choice is yours. You can continue playing by the old rules in a game that has fundamentally changed. Or you can adapt your strategy to the reality of a world where central banks have created more money in the last 15 years than in the previous 200 years combined. As Ray Dalio frequently observes, you can have opinions about how the world should work, but it's better to understand how it really works. And how it really works today is very different from how it worked when most traditional financial advice was created. If you observe carefully, you'll see we're living through a monetary experiment unprecedented in American history. The result of this experiment is still being written. The question isn't whether there will be consequences. The question is, will you be prepared when they arrive? History is an excellent teacher for those willing to learn from it. Patterns repeat because human nature doesn't change. Understand the patterns, understand the incentives, and you'll be able to navigate any economic cycle with wisdom and preparation.